All right, welcome back. So, last time we concluded with accruals. This is probably part 6, I want to say. Maybe part 5. Who knows? Who cares? Anyways, adjusting entries. Here we have accruals and we have an example for accruals. So let's get into it. Microcomputer Services began operations on August 1st, 2017. At the end of August 2017, management prepares monthly financial statements. The following information relates to August. Okay, so this is for accruals. This is an example for just accruals. At August 31st, the company owed its employees $800 in salaries and wages that will be paid in September 1st. Then it says on August 1st, the company borrowed $30,000 from a local bank on a 15-year mortgage. The annual interest rate is 10%. Okay, annual interest rate is 10%. So that's 3,000. Keep that in mind. Divided by 12. Okay. All right. Revenue for services performed but unrecorded for August totaled 1,100. So revenue for services performed but unrecorded, which means they have not paid us yet, for August totaled 1,100. So now it says prepare the adjusting entries needed at August 31st, 2017. So let's take a look. The first one looks like that. That should be pretty straightforward. Okay, it tells you what the number is, 800 in salaries and wages. That will be paid on September 1st. That is the next pay period. So it's just 800. 800. Salaries and wages expense, salaries and wages payable, 800, 800. Okay, if you see something like this on a test, I would worry about the accounts first. Okay, salaries and wages expense, salaries and wages payable. Then worry about the numbers. Now, some teachers maybe, have a stick up their ass or something like that and make it real difficult on you. And then you'll see salaries and wages expense, salaries and wages payable for A, B, C, and D and stuff like that. And then you will have to worry about the numbers. So if you see that, then don't worry about the accounts. If everything looks the same as far as the accounts, then don't worry about the accounts. But if you don't, then knowing which accounts should be affected by these adjusted entries will help you out a lot. And then you might not even have to worry about the numbers, okay? Because if there's only one that says salaries and wages expense debited and salaries and wages payable credited, then you know that's the right answer and you don't have to worry about the numbers, okay? The second one, on August 1st, the company borrowed $30,000 from a local bank on 15-year mortgage. The annual interest rate is 10%. So for this one, this is on a monthly basis. Okay, so we have to accrue for just that 1 month. Okay, again, worry about the accounts first. I know that I have to book interest expense and interest payable because I haven't paid this yet. Okay, I haven't paid the interest. I haven't paid the principal yet. So I just have to accrue it for that 1 month. Okay, for that 1 month. So the annual interest rate is 10%, and it works the same way. So 30,000 times that 10%, which is 3,000, and I need a calculator. Give me a calculator. 3,000. Anyways, okay. I'm not gonna worry about the math for now. Okay. I'm just gonna trust what they have here, which is 250. You can go figure out the math later if you want. Okay, what you have to do is just take 30,000 times 10% and just do it like we did for notes payable, which is divide by what is it? By 12. Okay, divided by 12. 12, I believe. Right? Divided by 12. I think. Okay. Anyways, math is not my strong suit, but you have to go back and figure out how to come up with this 250. Okay? But I'm pretty sure that's right. Anyways, number 3. Revenues for services performed but unrecorded for August totaled 1,100. In this case, worry about the accounts again. Just like we saw before. You debit the accounts receivable. Okay, this is what we earned. It would have been cash, but they haven't paid us yet. Okay, so we open up an account for these individuals, and then we credit service revenue to show that we earned these $1,100. So that's 1,100, and that is all she wrote. That's all she wrote. Um, so that's this example for accruals. Okay, for accruals. Then after that, okay, then after sometimes I pause. Okay, I pause. The mind works in mysterious ways. But anyways, after that, you prepare adjusted trial balance. Adjusted trial balance. At this point, I will show you what an adjusted trial balance looks like. It's just like the regular trial balance, except it has all these new accounts, if you have them, from these adjusted entries. Okay. Um, and you know what? Maybe not this video. Maybe we'll go back. I'll go back to this number 2 and figure out the math on that. Okay, figure out the math on that. So, for this one, 30,000, and it's a 15-year mortgage. The annual interest rate is 10%. Okay, so every year you have to um, pay this 10%. This 10% um, interest. Okay, 10% interest for this mortgage. If you don't know what a mortgage is, don't worry about it. If you're taking an introductory accounting course, I wouldn't bet that you would know anything about it. You can ask your parents. Basically, it is a form of a notes payable. Okay, it's just very very long term. Okay, so how they got this 250 was just I think, as I said before, 30,000, okay, multiplied by the annual interest rate. Remember, it's annual, 10%, which is 3,000, and then divide that by 12, or multiplied by 1, which is still 3,000 divided by 12, to convert it to this 1 month, which is 250. Okay, which is 250. Now, you might be saying, whoa, what if it is semi-annual? Semi-annual, huh? Oh, you thought you were going to stop me. Well, semi-annual is still going to be 1,500, right? 1,500 divided by 12, because half of 3,000 is 1,500. You can play around with these numbers, It's 1,500, and 1,500 divided by 12, or multiplied by 1 divided by 12, is going to be 125. Guess what? 125 times 2 is 250. You see how math can get so confusing, right? Um, or you can just go with, um, simple shit. 30,000 times 10%, 250. What I want you to worry about really is just that counts at this point. That counts, and then the numbers will come to you naturally. You can spend a whole. If you stare at something long enough, you'll eventually get it. Okay? So I changed my mind. Let's go to trial balance. Okay? So after you post all these, okay, journalize and post all these adjusted entries for both deferrals and accruals, then you prepare an adjusted trial balance. Okay? So it's prepared after the adjusted entries are journalized and posted after you, as you see here. And again, all the trial balances do, whether it be the vanilla, the adjusted, the post-closing trial balance, um, they all just ensure that debits equal credits. Nothing more, nothing less. Okay? And then, after you do the adjusted trial balance, all the accounts should be adjusted in theory, and then you can prepare financial statements. Okay? Now, again, there may be errors, so you have to worry about that. So, um, if the debits don't equal the credits, then that could be a good indication that something is wrong. Okay? But if the debits do equal the credits, something could still be wrong. Okay, so, but it's a good indication if the debits equal the credits. That's all I can say. Okay, so this is what it looks like. Okay, again, assets are listed first, liabilities are listed second, and then finally all the stockholders' equity accounts. And if these two numbers match, then you should be on the right track to preparing the financial statements. So you can prepare the financial statements right from the adjusted trial balance. Okay, here from revenues to all the expenses. Okay, so revenues all the way to the expenses. That's your income statement. Okay. Um, then from your income statement, you can prepare your retained earnings statement. Okay, that's the connecting statement. Okay, so you have to use the income statement for net income. Okay, so net income again is just your revenues minus your expenses. That gets added to your retained earnings if you have the beginning retained earnings, and then you subtract out the dividends, and that will be your retained earnings for this period. Okay. Then your retained earnings go to the balance sheet under stockholders' equity with the common stock. Your liabilities are listed where they belong under liabilities, and then your assets are listed under assets where they belong on the left side of the equation. You can see here, okay, that this is really a representation of your balance sheet, okay? Um, it's just listed in terms of debits and credits. Cumulative depreciation is an asset, but it's a contra asset. That's why it's listed on the credit side. So when you go to prepare the financial statements, you will list all these assets, and then you will subtract out the cumulative depreciation. Okay, you will subtract out the cumulative depreciation. Liabilities, no contras there, so they just get added together, all added together. Then your common stock goes under stockholders' equity, and then we already explained the income statement and how that goes hand in hand with the retained earnings statement, and dividends get subtracted, just like expenses get subtracted from retained earnings, right? From retained earnings, and then your net income is added. Your net income is basically your leftover revenue, right? After you subtract the expenses. So that's it for the adjusted trial balance. Hopefully that makes sense to you. Then you can prepare the financial statements. Okay, so basically we covered two steps here. Um, Step 5 and then step 6, which is the adjusted trial balance. Now the adjusted trial balance, we can spend more time on preparing this, like steps 5 and 6 and also 7. Okay, and also 7, which is preparing the financial statements, because there is a tool that you can use called the worksheet. Okay, and the worksheet will be very helpful in getting you from step 5 to preparing the financial statements. Okay, so we'll see that probably in the next video, or we'll spend more time on this trial balance and preparing the financial statements. Okay, so I'll see you in the next video. Peace.